Welcome to Fidelity Soundbites, our straight-to-the-point monthly podcast on investing. I am James Abela, your host, as the manager of the Australian Future Leaders Fund and also the manager of the Global Future Leaders Fund for Fidelity. Today's bonus episode, we are sharing with Sam Heithersay, the resources specialist who sits in Australia. Welcome, Sam.
Thanks, James. Happy to be here.
Sam, the markets have been over a few cycles of the last couple of years, had our free money cycle, we've had our value rally, quality rally, and now it's really getting real. There is a reality sense in the marketplace. So resources done really well in the last 12 months. In fact, in the Australian market, in my universe, Australian X300, X50, it's now 30% of the index, which has only happened 3 times in 15 years. So what do you make of that? What do you think's underneath that?
Yeah, well, I would add to all those cycles, James, demand shocks from COVID, supply shocks from Russia, Ukraine, structural themes emerging with the acceleration of EV adoption that's driven lithium to new heights. All of that packaged up into resources becoming a larger part of the index. But I think it probably comes down to the appeal of real assets. We've had financial assets, intangible assets, and now we have real assets. These have intrinsic value, whether they're inflation hedge or a part of the EV transition. And so I think it's the appeal of the commodities themselves and stocks as a leverage to those commodities that's made resources a larger part of the index last year.
Yeah, it's definitely been huge, and I think it's definitely a reality check, and that's why I think we are getting much more real, and resources have done really well for that basis. Let's touch on one which has been, glittering this month. March and April is gold, so it's finally been this haven that it has been for many decades and hundreds of years, and there's always been financial assets to supplement that safety, but now the world is getting much more focused. So let's talk on gold. What do you think about the gold environment, and is that rally done?
Yeah, well, gold is now touching US $2,000 an ounce. It's a record we saw early last year, and previously, but it's still a signal to the world that gold certainly retains its value as a credible store of wealth, as you're right, it has throughout history. And I think it's also acting as an inflation hedge in this environment with persistent inflationary pressures. I'd add to that the safe haven appeal of gold when we're dealing with banking stress and macroeconomic uncertainty. And so that's what's driven it to the record highs that we've seen at the moment. It's already rallied 25% off its lows since November. That alone would suggest we're closer to the end of the trade than we are at the beginning. But we could see a move higher here if increasingly we see the market pricing in monetary easing as opposed to tightening. And gold's safe haven status could certainly add to its appeal if we suffer a hard landing or more banking stress. And gold's certainly done very well in previous recessions, outperforming 5 of the last 7. So I think we could certainly see a leg higher, but we're probably closer to the end of this trade.
Yeah, okay, great. And we recently wrote a joint paper together on decarbonisation focused around transition metals. So maybe you touch on, transition metals and what's your view on that? And also that seems to be a structural trend. Is that your view?
Yeah, well, in that note, we dived into the role that minerals will play in the EV transition. And it's fairly obvious, 6 times more minerals in an EV than a combustion engine car. And we expect it to grow as EVs as a proportion of new sales. And so there's clearly a demand profile that's more structural for minerals. But I think the point when we made in that note was very much that it's still subject to a cycle. That the structural themes doesn't mean that the minerals have the escape velocity to escape a typical mining cycle. And that's certainly what we've seen recently with, lithium, even copper and nickel. So, yeah, I think the view is very much unchanged on in terms of the structural theme and the structural outlook. But as always, we need to be mindful of where we are on the cycle to understand where's the best opportunity to gain leverage to those transition metals.
Yeah. Now, Pilbara's one was in my universe, has now graduated to the top 50, went from 20 cents to $5 in 30 years. You don't see that very often. Lithium price, went vertical. You touched on that as well. How about the other ones, such as nickel and copper? BHP's just made a bid for one of their big copper producers. There's lots of copper talk at the moment saying they haven't had big copper discoveries for many, many decades. So what's your view on the other EV related ones, nickel and copper?
Yeah, lithium's price rally has been quite remarkable, and you're right. Seeing Pilbara rise to its heights has been incredible in the index. I think the copper and nickel are other key EV transition metals that we called out in that paper. And copper, of course, is used not just in the battery, but mainly in the infrastructure to support EV transition as a great conductor of electricity. But it also has many different markets and end uses. And so I think it's being torn between dual roles. One, it's being part of the EV transition that we all know, and it's got a structural bullish theme as a result. But it also is in part of many industrial end processes in markets.
Yeah, like electrification and things like that.
That's right.
Grid building.
So it means as a result that it becomes what we would term doctor copper. It becomes a weather vane for macro uncertainty. And so it gets caught up in those dual roles, and that's where we see copper trading down to be weaker last year. That's why we saw BHP capitalising on that weakness by making a bid for Oz, because they obviously saw the strategic value there. And nickel has a similar dynamic. It has a long-term structural theme on EVs being part of the battery, but it also is mainly driven by industrial end uses that seem weaker right now, and that's why it's suffered some weakness as a result. 13% down the last 3 months. There creates opportunities in that weakness, though, if you are a believer on the long-term structural thesis as we are.
Yeah. Very good. Great. And how about the more obscure sort of areas, or not as obvious, so rare earths, graphite, and perhaps manganese? What's your view on those?
Yeah, often neglected. These are the obscure minerals and metals that we will be equally important to drive the EV transition. Graphite, it's used in the battery. It's the negative sign, the anode. Manganese is much more on the cathode side, the positive side. And rare earths, while they're not directly useful for the EV battery as much that sells, they're very important for the drive motors and also for wind turbines. So I would say for all these obscure, more obscure or perhaps more neglected parts of the EV transition metal bucket, we need to be mindful that they have their own unique supply-demand dynamics. They shouldn't be neglected. They will not likely be a part of the EV transition. It just has to go up the learning curve to understand a bit more about what's going on in that unique asset, a unique commodity from a supply-demand perspective.
Yeah, certainly a happening space. There's a lot going on. Another big thing, Sam, is M&A. M&A's picked up hugely all around the world. Locally, you've had BHP, Osmin, you've got all the stocks that I follow. A lot of them are going into the top 50 because they've just grown from like 5 to 10 billion to now some of them over 20 billion. But you've got a lot of M&A around the world. Glencore, all the big energy and resources stocks are also doing their own things in terms of delisting and ESG movements. So what do you think it says, and what do you observe? What are your key takeaways from all the M&A activity all around the world?
Yeah, it's been incredible to observe the ramp up in M&A we've seen the last year in the resources space. You're right, Glencore Tech stands out as one of the major deals that we see in the resources space, the potential to build a $90 billion company. But closer to home, we've seen BHP and Oz. That's voted Newmont, Newcrest, Albemarle and Liontown, and at the smaller end of town, Andrew Forrest's Wyloo and Mincor. So that's a range of different commodities there. That's diversified copper, gold, lithium, nickel. And one interpretation of what that signals is that mining companies confronted with high cost and capex inflation and find it just more appealing to buy than build. But I think that probably understates the other signal that's at play here, which is that they see longer term strategic value.
Yeah, it goes between your cycles and cycles within cycles. The strategic cycle is there, and then the up and down supply demand commodity cycle actually provides opportunity to reconsider that long-term cycle.
Yeah, exactly. They see the long-term structural outlook that we see. They see the short-term cyclical weakness, and they see that as an opportunity. And so it was a bit of a wake-up call, some of these deals coming through to equity markets that have perhaps followed the cyclical without appreciating as much the structural strategic view that some of these corporates see.
Yeah. So what does it mean for Australian investors? Your head in resources is a global marketplace. It's not localized. So it is global. What do you think, if you directed Australian investors towards a few things this in the next 2 to 3 years, where would you get them to focus? Yeah,
well, I think we've touched on the role that real assets, the commodities that resources play in as a diversification, as diversifying in your portfolio as an inflation hedge. We've touched on the role that metals will play in the EV transition. I think what we haven't really touched on, and probably something I'm going to be looking for more and more, is the strategic value of those resources geopolitically, not just to defence, but more to secure the raw materials that will be needed to fund and to fuel this transition. We've already seen some of the statements of intent from the US with the Inflation Reduction Act and the EU with the Critical Raw Materials Act. I think this is the first step towards growing strategic importance of some of these assets, and I think we'll start to appreciate that over the next few years.
Okay, perfect. All right. Any final thoughts or any final comments, just more broadly on resources in the Australian market?
I think Australia is blessed with abundant resources. We are going to be critical to this transition, and you're right, they form quite a large part of the index, and we have great exposure. So I think it's, as much as there is geopolitical uncertainty around the pace of the transition, I think that Australia is in a pretty good place to be able to ride those waves wherever they arrive.
Beautiful. Excellent. That's been interesting. Our resource is definitely very, very topical right now. And I do think Australia is a massive producer and owner of assets that we are very rich and lucky to have. So thank you, Sam, very much for your time. That brings the end to our episode. So thank you very much for listening. If you have enjoyed these episodes, please do subscribe to the Sounds Bites podcast series. Thank you very much. And we'll see you in the next one.
Some important information on today's podcast. This podcast is issued by Full Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australian products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.